What's going on, guys, and welcome back to another video. So today was a very important day because the Federal Reserve decided to raise rates. Yeah, they did raise rates by a quarter point, and that was expected. But because of these rate increases that we are projected to see over the next year, what many people are doing is they're making moves with their money. And what I want to do in today's video, after we address what the Federal Reserve did today and their projections for the future, I want to give you some money moves that you should be making or you should be avoiding right now that rates are going up. So let's talk about this for a second, because for the past 6 months or even more, we've been expecting what happened today to happen. We know the Federal Reserve, they raised rates by 25 basis points. That was exactly what was expected. Only one member tried to get it to 0.5. So just understand that there is some, and that was, I think, Bullard that tried to do that. So just understand that there's the common consensus among the Fed is, okay, 0.25 is good. 25 basis points is enough. And that will probably be consistent all the way through the end of this year. But they also gave projections that are very telling as to where we are going to see the economy go from here on out. So before I give you some of this advice as to what you should potentially be doing or looking at with your money, let's talk about what the Federal Reserve said today. So today, the Federal Reserve, they revised their end of the year projections. I want to address some of the big numbers. The real GDP is projected down to 2.8%. This is likely due to the war, gas prices, and really uncertainty in the economy, which causes consumer sentiment to slow down. Like, we are going to go out there and just spend, a boatload of money right now when we don't know what's going to happen. We don't know how long gas prices are going to be elevated. We don't know how long the war is going to go on. We don't know how high inflation could potentially peak before it actually comes back down. We do know that our unemployment rate as of right now is just 3.8%, but according to the Fed, they're projecting it to be 3.5% by the end of 2022, 3.5% by the end of 2023, and then tick up to 3.6% by the end of 2024. We do know that PCE inflation for the end of the year is at 4.3%, which is more than previous projections, but it's better than where we are right now. We also know that the federal funds rate is expected to be at 1.9% by the end of the year. But, and just keep this in mind, when you factor in 0.25 and you do this over 7 times, this is not 1.9, okay? That's the issue with this. 7 times is 1.75, which means to get to 1.9% at some point between the next 6 Fed meetings, we would have to see in one of these, it'd be a 50 basis point hike. So just keep that in mind. If you are an investor, this could potentially scare the market. So just understand that. And another very interesting projection is that the federal funds rate is projected to be higher than what it was or what we saw in 2018. Okay, so keep this in mind over the next few years, or actually over the next 2 years, we could potentially see the federal funds rate go higher than what it was in 2018. And in 2018, that's when we saw the housing market kind of take a dip. So if you are a home buyer, you need to be understanding of what is potentially coming there. And I will address that in a minute as well. So now that we know what the Fed said today, let's talk about what the moves you should be making with your money is right now. And just keep in mind, this is not personal financial advice. This is just generic, just good, financial tips, all right? If you want specific advice regarding your exact financial situation, make sure you talk to a financial expert, okay? Don't go listen to just some random guy off of YouTube, because I have no clue what your specific financial goals are, what your current situation is, and neither does anybody else, all right? So let's get right into it. What money moves should you be making right now? Well, the first thing that I recommend, which I've actually recommended for months now, is to pay off your credit card debt. Because what we are going to see, and it's not going to be life-changing, but as the Fed raises rates, which they just did today, we're going to see credit card companies start raising their rates as well. Okay, so you will be paying more. Instead of maybe that 15% annual interest rate that you received when you first got the credit card, maybe now it's going to be 16 to 17%. And experts say that for every quarter point rate increase that we see from the Fed, you will likely see 1% increase on your credit card interest rates. So just understand, it will actually accelerate. Now, if you have the ability to pay off your credit cards, I recommend you do that now. That's just good, sound advice. And if you're struggling to pay off credit cards, then look into something, maybe a consolidation. Maybe you pay down your loans a little bit quicker, your debts a little bit faster, right? Or maybe you can figure out a way to pay off your debts, right? Or at least some cards, take that money, push it over to that you're paying, push it over to the next card, and you kind of have that snowball effect. And if you want to know more about the snowball effect regarding debt payoff, you can look up I think Dave Ramsey for that one. That's one thing I do recommend you do is the debt snowball, because that does help. But as far as listening to everything Dave Ramsey says, well, that's up to you. Now, the next thing is if you're planning on buying a car, and this is something that I was talking to a few people just this week about potentially buying a new car, right? But here's the reason why I wouldn't want to buy a new car at this time. The Fed's rates and these hikes that we're going to see, this isn't going to make or break a purchase, all right? It's just not. And I wasn't planning on going in and buying a car with a loan. I was planning on just buying it cash. Well, that would be a very dumb idea at this point, because I am expecting prices to come back down, because I was looking at buying an electric vehicle. Now, keep in mind that for every 25 basis point hikes that we see, if you get let's say a $25,000 car loan, it's going to cost you about an additional $3 per month. Again, it's not going to make or break the purchase. And a lot of people have been saying that buying an electric vehicle and locking in a lower interest rate is a good idea. Well, yes, it would be a good idea if we expect gas prices to stay elevated or go up. But if they are going to come back down, then that's not really the case, okay? However, buying an EV at the top of the market, which I believe we are at now, paying a little bit more for that car, and also paying a little bit more on interest, makes no sense. It just doesn't make any sense. So what I am planning on doing is I'm going to wait for gas prices to come back down. I'm going to wait for our supply issues to somewhat, figure themselves out, because I can tell you right now, any type of electric vehicle or even a gas-powered car, being that aluminum's more expensive, right? Every product is more expensive. So why would I overpay for a product right now? Getting a loan, locking a loan at a higher rate. Okay, it's going to be lower than what it will be in 3 months or 6 months or in a year. But why would I lock in a rate that's higher than what it was a few months ago? It just doesn't make much sense. So if you're planning on buying a car, whether it's new or used, I'd highly recommend you wait. As far as bank savings rates, I was talking to one person today about this. They're thinking about putting their money into the banks. Because, well, the banks, for one, it's protected. You don't got to worry about the stock market. You don't got to worry about it coming down and you losing money. But at the same time, they're saying, yeah, because interest rates are going up. Well, yes, rates are going up, but this isn't going to make or break you. Okay? Just keep this in mind. At 0.25%, okay, just to give you an idea, let's say interest rates at the banks moved along the same lines as the Fed's rates, okay? Let's say that's how it happened. That's how it works. It's not, but let's say that's how it works. If you had $100,000 in your bank account, okay, you had $100,000 sitting in there all year long. At the end of the year, 0.25% is $250 that you would get in interest for that year. I guarantee you, it wouldn't take a genius to put $100,000 into the stock market. Even right now, you could easily make more than $250. There's some people that probably make that in a day, okay? Again, even at 1%, even if all you do is you can trade at 1%, you'd make $1,000 in one day. You'd make 4 years worth of interest instead of sticking it in your bank account. So, bank savings rates, don't expect banks to react right away to these changes, and especially don't expect them to come out and just give you a huge rate of return, because that's not the way banks work. Okay, that's not the way they make money. The next thing, and possibly the biggest reason and the biggest issue that people are having right now, is when it comes to buying a home. So if you are looking at let's say a 30-year fixed rate home loan, chances are you're going to be over 4% right now. That's the average 30-year fixed rate. But just understand, this is up 1%, over 1%, just from a few months ago. The expectation is as the Fed is going to continue to raise rates at 0.25% each meeting. Just understand that in the next 6 weeks, we're going to see rates go up even more. Okay, because and again, these meetings, okay, these happen about every 6 weeks. So here's the reason why I want to bring this up, because this is a common mistake I see a lot of home buyers making. Is home buyers are pushing off their home buying, kind of their idea, right? This dream of theirs. I'm gonna push it off because home prices are gonna come down. Yeah, home prices will come down a little bit, okay? But here's the other thing. Rates are going up. If you're a cash buyer, you wouldn't care about rates at this point. You're gonna care about the home prices going down, okay? As an investor, I am looking at home prices to drop so I can come in with the cash offer. I'm not worried about those rates because I'm not gonna get a loan on it immediately. I'm just gonna go buy it cash. Then I'd fix it up, rent it out. Then I'd go and get a loan on it. Okay? So here's what you need to keep in mind. Your purchasing power, if you're a homeowner, just because prices go down but rates are going up, right? Different directions, it's actually going to decrease your purchasing power, which means you can get less of a home. Which means that $500,000 home that you really liked and you could afford, well, as rates go up, if prices don't go down, then you can't afford it. And here's what I can tell you. The supply in homes right now is not there. We don't have enough homes. We just don't. The demand is definitely up. Rates are increasing, but the supply isn't there. So guess what? Everything is pointing to it being harder and harder to buy a home the longer you wait. So here's what I can tell you about home buyers. Waiting is probably not the right answer, okay, because you're not going to get the home that you really want. However, waiting is the answer if the homes that are available are not the homes that you want, okay? And now you're probably thinking, well, that's confusing. It is. It's very confusing. Right now is probably not the best time to buy a home unless you can find a deal that's undervalued. You can put in some sweat equity into it, right? And that way, if it's already fixed up and it's move-in ready, chances are you're not going to get a good deal no matter what, no matter where you're at. But if it needs some work, needs some TLC, then you can potentially get a discount, all right? So I just wanted to fill you in on some of those money moves because I know a lot of people are asking, what should I do? There's just so many questions. I still have a lot of uncertainty in this market. I don't know where we're going. Honestly, nobody does. But the good news is that the Fed did raise rates like everybody expected. But the bad news is there's still a bunch of questions moving forward. So we will see what happens moving forward. But as always, as I know more, I promise I'll come back on and share all latest news and updates. Just want to thank you guys for watching. Have a wonderful rest of your day. Consider subscribing, and I'll see you guys on the next one.